You're watching Beyond Market. Welcome. I'm Esther Awoniyi. Many thanks for joining us. On today's show, we'll explore how pension fund administrators are staying ahead in the current investment space. As always, you can join the conversation with the hashtag Beyond Market. You can also send your thoughts and your comments to my Twitter handle too. It's at Esther O. Awoniyi. Now, staying ahead is key for pension fund administrators, but how does the rise in inflationary pressure and compressed fixed income yields as well as lending rates impact their investment decision this year? Dave Uduanu, CEO of Sigma Pensions, joins me for today's discussion. Dave, thank you so much. It's a pleasure to have you on the show with us today.
Thank you.
Now, let's start with the current investment environment for pension fund administrators. I mean, PFAs now find themselves in a position where they're now struggling to give contributors real return for their investment at the end of each year, of course, in excess of inflation now. There's that combination of the lower yields that we saw last year and then equities markets that continues to underperform for its third year. But let me hear you share your thoughts starting from 2019, how that year was for you, and of course, what the strategy is for 2020.
Okay, good. 2019 was a good year. I can say that now relative to what we have. We started the year with very high yields in the bond markets and treasury bill markets. And that, continued for the first 3 quarters of the month until central bank came up with the policy on OMO. However, these yields were sort of depressed due to the poor performance of the equity markets. So 2019, a number of PFAs were able to deliver returns that were slightly above inflation in the 4 key funds that we manage. But however, this year is looking tougher, is looking challenged. Bond yields are below 10%, and treasury bill yields at 4%.
All below inflation.
All below inflation. And I think the key question is, how do you manage savings in a country where yields are below inflation? And, so just even aside from pension funds, for the man on the streets, if you want to achieve the goals of financial inclusion, which is for them to open bank accounts and keep their money in banks, you have to ensure that at least interest rates are at par with inflation or very close to inflation, but that's not the case here. So PFAs are really going to struggle this year. However, the equity market, has come to support the yields. I mean, in the first month of the year, we're just within the first month, it's about just under 10%. And in the first 2 weeks of the year, it was touted as the best performing stock market in the world. That was early days.
But some PFAs that we've spoken to so far have said that they actually, going into the year, they actually do see a decline in valuation of some key stocks, especially the banking, specific banking names now that will, of course, they'll have good dividend yield return for investors. And of course, they're also lamenting about the unavailability of additional alternative asset classes to help support what the equities markets can deliver to them in 2019. Is that your sentiment too?
Well, the market is driven by liquidity. We see a lot of PFAs and indeed other investors, jumping into the equity market. The market has been depressed for the last 3 years. There's some good names that's rallied in the last 2 months. Banking names will struggle this year because, as you know, central bank raised the CRR rate, and that means that banks, again, are going to struggle with liquidity. A lot of the money is locked up in the system, and that will impact the returns and profitability for the year. However, we think that the market will do much better than last year. We think that investors simply don't have an option but to put more monies in the market. PFAs were sitting at less than 10% equity allocation. They can potentially go up to 25% or even 30% in some funds. I don't think that the foreign portfolio investors will jump in now until there's overhang around the currency, there's clarity on the currency. So we think that the equity market is going to do better this year than last year. On the alternative side, I think one of the things that this environment has forced is PFAs to start looking at alternative and be more creative. And that will lead us nicely into the discussion on infrastructure. But even before then, PFAs are now looking at investing in corporate bonds, while some of the corporate names are coming to the market to raise bonds rather than go to banks to borrow money. So I think that PFAs now have to think outside the box. I would say that in the past 5 years, they've been sort of sitting on the desk because bond yields were very high. Now they have to look for alternative investments and look for how to channel those growing pension funds.
So is that how, is that the thinking of for Sigma pensions now? That is what you
certainly,
plan to do? Okay.
Certainly. We're looking at how to make this investment. It's tough, it's difficult because the environment is challenged. So for instance, in the area of real estate and housing, there's a significant demand. The housing deficit is huge. And pension funds sitting at 10 trillion can deploy some of those capital in the housing markets. It's a question of finding the right method of delivering the houses at the right prices. We believe that the demand is there.
But that has always been a problem. We've had these conversations around, of course, real estate, building appropriate vehicles to ensure that risk is mitigated, etc. But that conversation is still ongoing, and there doesn't appear to be a solution, if you will, at this point. So what makes you confident that will work out this year?
Well, I think that because the yields have come down significantly, we're beginning to see mortgage rates that are very close to 10%. And what the PFAs are trying to do is to come up with a vehicle that allows borrowers to borrow at 9%. But we also have equity in the vehicle in a way that allows us to make more money on the equity side. I don't know, for some reason it's difficult to get anything done here. You have all these ideas, you go talk to the regulatory authorities, there's always one roadblock or one stumbling block. But I would say that the pension funds are really working hard. We have a housing work stream, which we've worked very hard on, but for some reason, it hasn't seen the light of the day. The other collaborators and other partners that we believe should come to the table to make this work. And one of them, obviously, is government. We believe that at the end of the day, if government can support us by way of maybe, I don't want to use the word guarantee. When I say government, not federal government, but government agencies, maybe InfraCredit or one of those sovereign wealth funds, by way of guarantees, or just to ensure that when the monies are deployed in housing, it comes back. I think that is where we are on the housing solution. And we've made our submissions to the appropriate regulatory authorities, and we're just expecting them to get back to us.
Okay. Now, speaking about government, obviously you're quite aware of this trending story of the federal government seeking to borrow 2 trillion naira from the 10 trillion naira pension fund pool. Now, the Pension Reform Act of 2004 empowers the government to borrow 20% of the pension fund for national issues. But what is your take on this discussion, on this conversation that's currently ongoing? 70%, that's already in government securities, meaning that PFAs already invest 70% of those funds already in government securities, and now the government is coming for 2 trillion. How is this, what is your own take on the conversation?
Well, I think the story out there is very sensational. So I happen to sit in the committee that is discussing this.
Okay.
So the reality is that government is not going to borrow 2 trillion. What the government is trying to do is to see how to use up to 20% of the pension fund, which happens to be 2 trillion, to invest in critical national infrastructure. So a committee was set up, is made up of Sovereign Wealth Fund, PENCOM, Ministry of Finance, and Central Bank. And where we've landed is that there will be a fund that will be set up and managed by the Sovereign Wealth Fund. So it's not government managing the fund. The two critical issues around, I think there were 2 issues. One is government borrowing. So government is not borrowing. It's a fund that will be managed by a Sovereign Wealth Fund. It's a commercial fund. We're even trying to crowd in, international investors, because if the pension funds put money in the fund, then we think that international investors will be encouraged to put money in the fund. The critical problem is the interest rates. At what interest rate? Now, government, with the story out there, I think one of the governors put it out there, 6%. 6%, 7% happens to be the number at which some of the federal government bonds are trading at. So they're saying that if this environment continues, which they believe will continue, then the fund can issue notes at 7%. But what we say to them is that the fund should issue note at commercial rate. If the commercial rate is 10%, yeah, that's what it is. If it is 12%, that's what it is. We don't think that the present interest rate environment is sustainable. It is not market determined. It is the distortions in the market that is causing rates to go down. And we believe that rates will go up. Rates have even started going up. We're seeing rates about 6%, 7% now. So the fund will be managed by a sovereign wealth fund, professionally managed. The pension fund will sit in the advisory board, so will Federal Ministry of Finance, so will the Central Bank. The key thing is that there are about 20 national critical infrastructure projects that will be sort of warehoused in the fund with the presidential approval. Apparently, for you to do that, you need a presidential executive order. So one of the things that we're seeking to do is to get that done so that those assets will be warehoused and taken out of the ministry that typically will build them under a procurement process. Those assets include things like Second Niger Bridge, Lagos-Ibadan Expressway.
Okay, so they're all specific.
They're all specific assets. Projects. So
okay.
The fund will then issue bonds that are tied to those assets. And the idea is that those projects will be run by private sector companies under a PPP arrangement. Those private sector companies will issue the bond. Then the PFAs are being encouraged to take an equity stake in the project so if you take, for instance, Lagos-Ibadan Expressway, okay. There's what we call the right of way. The right of way is, 500 meters, 1 kilometer between, along the expressway. Along that right of way, there'll be things like, trailer parks, there'll be hotels, there'll be all sorts of things, petrol stations that we build there. And when you sort of value them, there's a lot of value in the equity of those assets. So the thinking of the fund managers and the thinking of the committee is that perhaps if PFAs then lend by instrument at below double digit, maybe, 7, 8, 9%, whatever it is, then they get equity warrant, which allows them to participate in the upside on those right-of-way assets. At the end of the day, their blended return will be, as high as 15%. So I think we need to make that clarification. A lot of our customers have been calling us. Government is not going to borrow any 2 trillion. This project, this fund, will take at least 1 year to conceptualize, and the investment will be made over maybe a 5-year period. However, what we're saying is that this perhaps will be the most important investment project in Nigeria in the last 10 years. If you look at the national budget is 10 trillion. What is allocated to transport infrastructure is about 380 billion naira. That's less than $1 billion. It will take us 20 years to build this project. And you know how the budgeting system works. They make monies available, then when the money runs out, the contractor disappears. However, when you aggregate 2 trillion, and let me say, government is not borrowing the money. PFAs will invest as typical investors. And we're also looking at, DFIs like African Development Bank investing along PFAs. So it's going to be commercial. I think that that's the right way.
David, okay. If I could just come in here, we just need to take a break at this point, but just hold that thought. We'll come back and let you continue with that thought. So if you're just joining us, Dave Uduanu, CEO Sigma Pensions, is our guest today on the show, and we've been exploring how pension funds can stay ahead in 2020. Dave, thank you for your time so far. Let's pick up from where you left off. You're talking to us about this plan now to have the government through the sovereign wealth fund, you said, to access 2 trillion to address some critical infrastructure gaps. And of course, obviously, you seem very confident of this framework that's been put together.
Yes, let me qualify the confidence. The confidence is because I participate in the committee on behalf of the PFAs, and I'm privy to the discussions that are going on. So the point I was trying to make is that it's the politics of it. Politicians have to put the words out there. And maybe it wasn't properly communicated or properly understood, but I think it's important to put the word out there because, as you know, in markets, once you put the word out there, the animal spirits in people, they just get to work. Investors begin to grow up and things begin to happen. But I think that the country will be better off for it if it's structured in a commercial way. And I think that this will even be the beginning of a national infrastructure fund we've been asking for. What we've been asking government is to issue infrastructure bonds or create a national infrastructure fund that is run by private sector operators, people that know how to run funds. So the NSIA is going to set up a dedicated team to run this fund. That's the plan. And pension funds are going to be investors, just like we invest in private equity funds. We're going to sit in the advisory board to make sure that things are done properly. And it's the asset to be run under a PPP framework. Now, there are some elements that are still missing. The PPP framework has to be finalized. The national tolling policy has to be, because the roads will be tolled and commercialized. And, so these things, some of the projects are already ongoing. Lagos-Ibadan is ongoing, Second Niger Bridge is ongoing. If we complete them, put toll on them, privatize them, then the money is recycled back into this fund. So that's the idea. There's something that already started, the PIDF, which is Presidential Infrastructure Development Fund, which is run by NSI. It has 4 projects. It's going to be built on the back of the PIDF. So it's like a PIDF 2 or Nigerian National Infrastructure or Nigerian Infrastructure Fund. But I think that it's important to just put the word out there that government is not taking the money, is not borrowing the money. It is a government-led initiative which will be run by the private sector. It's also important to make the point that the pension fund, pension scheme, was a government-led initiative. Government thought about this, put it together, and set up a regulatory commission to now license private sector.
But you know that, for I guess for those who are also worried, the risk burden now is on the contributor now, not, well, compared to what we have in a place like, say, South Africa, where, it's all put together by the government. And that's why we've seen a country like South Africa before now, they've been able to use their own pension funds for infrastructure projects.
No, good points. So the other point is that government will backstop or guarantee the return on the fixed income side of these instruments, which is like we're buying government bonds. So there's no difference. The real conversation is about what is the interest rate that the PFAs are going to get. Is it commercial? And is it backstopped by government or a government agency? And there are talks about getting MIGA and the World Bank getting involved and all that. So I want to just say that I don't think people should fear. It's still at early stage. We are back to the drawing board, and they're experts in the room, trust me. They are very bright.
I guess that will put some minds to rest, knowing that the private sector is actually involved. Now, at 10 trillion naira, we're still being told that, look, we're still just, scratching the surface, and that, this is a country under the contributory pension scheme, that just covers about 9 million workers. And obviously, in a country of 200 million people, that is still scratching the surface. So obviously, this 10 trillion naira can be way higher than it is right now. So that's why we saw the micro pensions initiative by the federal government last year that is hoping to capture 30 million more people. What are your thoughts on this in terms of how we're proceeding with the micro pensions and what you're hoping it can do in terms of increasing penetration within the industry?
Well, okay, so the micro pension, it's off to a very slow start. And I think there are two issues. One issue is a lot of the people that are being targeted simply cannot afford to save. People, you need to earn enough money to save. So I would say informal sector rather than micro pension, because micro pension globally hasn't gained traction. The challenge with the informal sector is that a lot of the people are below the tax bracket. So a lot of them think that once I start paying pension, the government knows how much I earn, I make, and then I will start paying tax. So the tax reform still needs to be done, because one of the benefits of the pension fund is that it's tax deductible. I'm not widely optimistic about this pension fund growing on the back of micro pension. I'm more optimistic about it growing on the back of increased compliance, on the back of PFAs giving something back to the contributors by way of allowing them to access monies to acquire houses, get mortgages, and people then doing voluntary compliance. But more importantly, increasing the economic space. So if we do this critical national infrastructure, it's going to increase the economic space significantly. There will be jobs created. People will, then open pension account, and the pension funds will increase. 10 trillion is a very small amount of money by way of compared to the population of Nigeria. However, we've made significant strides. If you think that the total government budget is 10 trillion, the pension was still at 10 trillion. It's going to double. At the current rate, it's going to double in the next 5 years at 15% growth rate, based on what it is today, based on interest rate, investment income, and contributions coming in. Now, if we have more people coming into the scheme, then you can see. The other area that we need to talk about, and it's very important, is state government. Unfortunately, in spite of all the noise and cries the governors are talking about, not up to 7% of the state government are in compliance. So when they talk about using the pension fund, I often say to them, but you are not even part of the pension fund. How can you participate in what you are not part of? So if we, through the Federal Executive Council, compel or get the governors to join the pension scheme, to enroll their workers in the pension scheme, the numbers will grow from 9 million to maybe about 12 million, and we can see faster growth, because these people earn salaries on a monthly basis. They desire to have a pension. They need to have a pension because they are working for a subnational
But I'm just wondering, why aren't they being compelled to do so? It's obviously it's an urgent matter, and we know what the benefits are. They know what the benefits are. I mean, if they're talking about wanting to also be part of the pension fund at the national level, I'm just wondering, why aren't they being pressured to participate?
Look, we've gone around this thing for a while, and I think the long and short of it that some of the states, I dare say, are not financially viable enough to participate in the pension scheme. I mean,
so
this is my
the
opinion.
Pension Reform Act itself there's no place in that law that compels them?
Well, the first law was not a national law, but the second law, well, I'll use the word compels them to join. But you know the way the country is, is structured. The states are federating units. You cannot compel them. You will encourage them to join. And, even some of the states that have joined simply cannot meet the obligation because the Pension Reform Act requires that every month deductions are made and sent to the PFAs. But more importantly, when people retire, you pay them. The biggest problem is the backlog of accrued rights. Past due liabilities in the state, they are so huge. So perhaps what we can do is to work with the DMO and the state government to see, can we issue a bond on the back of this? I know you are going to come to this.
I know, because
it's
funny, we're talking about, the state government unable to make contributions. Even at the federal level, it's still a struggle for the federal level. There's a 400 billion, but I'll let you finish up with that, and then let's talk about how the federal government is trying to tackle this with their arrears.
So the states have a lot of arrears, and one of the rules is that once you start funding, at the arrears. You start making contribution towards defraying the arrears at 5% of the salary wage. Once the state looks at it, 5% going to the central bank escrow account every month and making deduction, they look at their number, the numbers don't add up, and they stay away from that. I think is the problem with the states. So how do we solve it? I cannot say. It requires a creative solution. Maybe again, like we're doing with infrastructure, we should put together a team of experts and see how we can. Because if we don't do it, we're going to have a situation where only people that have worked in the federal government and organized private sector will have pensions, while the state government worker is going to be a mess in the next 10 years.
And I think it might even be more difficult for the states with the minimum wage, because they have to pay minimum wage, and then of course that increases what they contribute
minimum wage
for pensions.
Contributions and all of
so
that.
I don't want that particular conversation to drag. And let's talk about this also recent development still connected to it. Arrears, according at the federal level, PENCOM says it plans to issue. It's in talks with the DMO for a bond to cover the 400 billion in arrears for federal government pensioners. I'm just wondering, it's new, and I'm not sure it's something we've done before, but what do you think? Do you see this working out?
Well, it can work out. I think from enlightened self-interest, with PFAs we like that, because I say enlightened self-interest because who are the people that will buy the bonds? The pension funds. So it becomes like self-financing, but what it does is that it puts money in the hands of government to clear these arrears and then make the scheme work, and government can spread the payments over time. So I think it can work. It will work if there's political way to do it. It's like every other bond. It's a bond dedicated to clearing pension arrears, and I dare say that the way it should work is that when you issue the bond, the proceeds should be deposited in the escrow account that is managed by PENCOM, and then all the backlogs are paid. Now, remember that, again, we are financing ourselves because the backlogs comes into the pension fund. So we get 400 billion into the pension fund, and then we'll begin to pay the retirees. Maybe they will take 25% of that, and the rest is spread over.
I'm just thinking that if it works out, there's obviously the possibility that it will happen again.
Oh, yes.
Because it's still irregular.
So if it works out, what government should then do is either to say on an annual basis, you put that accrued rights or past due liabilities in the budget on an annual basis, and make sure it doesn't happen again. Because if you don't, 5 years again you issue a bond. But it's not a problem. Financing, the beauty about finance is that finance people can solve any problem. They can do or not do. Yeah, finance, because what you do is that you have a liability of 400 billion, but you have income stream. So you spread it over 10 years. It's 40 billion. You put that 40 billion in the national budget, and it will pay off. But the PFAs have the money. The retirees are happy. Right now, retirees are unhappy. They're losing confidence in the scheme, because when they retire, they are not paid. I have relatives that have retired since last year. It's not even there. They basically living off their family members. But that is not what was envisaged under the PRA 2014. So I think that, again, it's not one of those things where we should speak a lot of English about. We should just do it. It's easy to do. Issue the bonds. PFAs will buy. PFAs are awash with liquidity. They will buy it at a good yield, and we'll move on with life.
Dave, thank you so much. Appreciate you being on the show today. And of course, very insightful conversation there with you. Thank you for your time. That was Dave Uduanu. He's the CEO of Sigma Pensions, sharing with us how pension fund administrators are planning to stay ahead in 2020. With that, our show for today. Thank you so much for being a part of it. Remember, you can watch the show at 5 p.m. West African time daily and have access to all previous episodes of Beyond Markets on our website. That's cnbcafrica.com. You can also stay engaged with the hashtag Beyond Markets. And of course, you can send your thoughts and your comments to my Twitter handle too. It's at Esther Awoniyi. For myself and the team, it's bye for now.